Hi there, and welcome to a new tutorial, Japanese candlesticks. In this tutorial, you will learn the concept of candlesticks, how they differ from bar charts, and some of the popular setups that have come to be identified in candlesticks, like reversal patterns and some continuation setups. Introduction: Japanese have used this charting and analysis technique for centuries. Only in recent years has it become popular in charting and technical analysis world. Charting data in candlesticks form uses the same data available for standard bar charts like open, high, low and close prices. While using exact same data, candlestick charts offer a much more visually appealing chart. The information displayed is more easily interpreted and analyzed. In the following example, you can see how a bar, single bar looks like and how a candlestick looks like. This is a single bar representing open price on its left side, close price on its right side, high price the top and low price the bottom. So a bar looks like this, whereas a candlestick looks like this for the same level of data. Start of the body. Now this white rectangular shape is called its body. Similarly, this black rectangular shape is called its body. The only difference is this is white or empty because it has a positive close as compared to its open, which means prices have closed higher above its open price, whereas in this case it has a filled body or a black body because prices have closed below its open. So if you see filled body candlestick or a black body candlestick, which means it had negative closing for the day. Close was below its own open price. Similarly here, close was above its open price. Hence it has an empty or a white candlestick. Now, bar charts have open and close prices plotted on its left and right side, whereas candlestick uses body, rectangular body to represent open and close price, and tops and bottoms or highs and lows for the day are plotted as lines above and below the body. These lines are also called hair or shadows of the body. They look somewhat like a candle with a wick. The rectangle represents the difference between open and close price for the day and is called the body. A white or an empty body means that open price is greater than close price. The black body or filled body means that close price is lower than open price. The open and close price are given more significance in Japanese candlestick interpretation, whereas high and low price are not considered vital in analysis. Following is a daily chart of Adani Power. In the above window, candlestick price information is plotted in the form of candlestick, whereas in the below window, price information is plotted in the form of simple bar chart or OHLC bar chart. And you can see candlesticks chart speak about information much more visually appealing way, whereas open high low bar chart tells us about open, close and high low price information for the day, but candlestick tells us much more visually appealing way. You can easily identify which days were positive days, which were negative days, which days prices remained unchanged, almost unchanged, or on which days prices failed to move up or low. You can see here This big white candlestick suggests us that it had a strong close. Big dark candlestick suggests us a strong selling day. A candlestick with longer shadow but unchanged body or a thin body suggests us that prices failed to go anywhere. Prices remained unchanged for the day. So, candlestick chart plots information in much more visually appealing way, whereas bar charts plots information up to the mark, but candlesticks gives them away in a much more visual way. Different shapes for candlesticks have different meanings. The Japanese have defined different candlesticks based upon the relationships of open, high, low, and close prices. Understanding these basic candlestick pattern is the beginning of candlestick analysis. Basic of candlestick. Different body combinations have different interpretation. Days in which open and close price is great are called long days. Similarly, days in which distance between open and close price is small are called short days. Days in which candlesticks have small bodies with upper and lower shadows that are of greater length than that of body are called spinning tops. These candlesticks are considered days of indecision. When open price and close price are equal, they are called doji lines. Doji candlesticks have shadows of varying length. So these four are the basics of identifying candlesticks. Each and every price data plotted as candlestick will fall in either of these four categories. It could be long days or short days or spinning tops or doji lines. In following diagram you can see long days have longer bodies with not so long shadows or high and low prices. Short days have shorter bodies whereas shadows are longer and body is short. Spinning tops have short bodies and longer hair or highs and lows. These are named spinning tops because they look like a spinning top. Doji candlesticks have unchanged prices, open and close price. As a result, body looks like unchanged or congested, whereas they have larger shadows or high and low prices, suggesting us that market is severely undecided or market is extremely undecided. Doji candlesticks. There are three different types of doji candlesticks. Let's go ahead and learn about them. There are different doji candlesticks that are important. Long-legged doji. Long-legged doji has long upper and lower shadows and reflect considerable indecision on part of market participants. So the first doji candle is a long-legged doji candlestick. It has longer upper and lower shadow and an unchanged body. Next is a gravestone doji. Gravestone doji has only a long upper shadow and no lower shadow. The longer the upper shadow, the more bearish the interpretation. This is a gravestone doji candle, the second in line. It has a longer upper shadow and an unchanged body. This is a bearish candlestick pattern. Dragonfly doji. It is the opposite of gravestone doji. The lower shadow is long and there is no upper shadow. It is usually considered quite bullish. Third and last in doji candles is a gravestone doji candle. It has long lower shadow but fails to have any or has a small or minimum upper shadow and an unchanged body. Unchanged body usually means it has unchanged open to close prices, which means market opened at this price, traded as low as here, recovered everything about of it and closed unchanged. So a dragonfly doji candle is usually a bullish sign. Okay, following is a NSE 100 chart. It contains one best 100 stocks listed on NSE. It's basically an average of best 100 stocks in NSE. Let's go ahead, zoom in, and let's see if we can identify some of the candlestick patterns. For example, this one is a long body day candle. Similarly, this is a positive long body. This is a negative long body. And so are these negative long body candle, negative long body candle, a positive long body. Similarly, these are short body candles, short body candle, a short body candle, and so on. And this is a spinning top candle. This one is a spinning top, a negative spinning top, and one more spinning top. Here you can find one more spinning top, a short body candle, and so on. Now, one of the most important candle pattern which suggests extreme indecision on part of traders was doji candlesticks. You can see here this is one of the best example of doji candlesticks. Market kept on falling down, then it took a pause, creating a doji candlestick or suggesting that traders are not sure in which direction to go, and on the next day prices continue to fall down. So this one can be identified as a doji candlestick also. And you can see doji candlesticks are formed on important strategic places, like prices kept on rising higher for 8 to 9 days, and then you see a doji candlestick which suggests traders are not sure in which direction to go, and then prices start correcting themselves backwards. So doji candlesticks are one of the important part of reversal patterns, which we will learn in following tutorial. Candlestick pattern analysis. A candle pattern can consist of single candlestick or be a combination of multiple candles, normally never more than 5. Most candle patterns are used to determine reversal points in market. There are few patterns that are used to determine trend continuation. If a reversal pattern has bullish implication, then an inversely related pattern has bearish implication. This simply means if one set of pattern suggests a bearish reversal, if it suggests formation of a top, the same pattern inverted in the opposite direction will suggest formation of a bottom. When there are patterns that work in both bullish and bearish situation, then they usually have same name. If there are patterns that have bullish and bearish implication, they will have different name, even though patterns are exact opposite of each other, whereas there are some patterns which are exact opposite of each other and still have same name. Reversal pattern. A reversal candle pattern is a combination of Japanese candlesticks that normally indicate a reversal of a trend. One serious consideration that must be used to help identify patterns as being bullish or bearish is the trend of the market preceding the pattern. You cannot have a bullish reversal pattern in an uptrend. You can have a series of candlesticks that resembles the bullish pattern. Hence, while using these reversal patterns, it's necessary to understand the condition of market, whether it is bullish, bearish, overbought or oversold. So if market is bullish, you cannot have a reversal pattern in a bull trend. Similarly, if market is bearish, you cannot have a reversal pattern in a bear trend. But in a bullish market or in a running or continuous market, you can have continuous pattern that will help tell you that this market is going to continue in its predetermined trend. Similarly, you cannot have a bearish reversal candlestick pattern in a downtrend. Let's now learn some of the popular patterns. First and the most popular pattern is dark cloud cover. It is a 2-day reversal pattern that only has bearish implication. The first day of this pattern is long white candlestick. This reflects the current trend of market and help confirm the uptrend to traders. The next day opens above high price of previous day, again adding to the bullishness. However, trading for the rest of the day is lower with a close price at least below the midpoint of body of the first day. This pattern acts as a significant blow to the bullish mentality and will force many to exit the market or reverse their position. Since the close price is below the open price on the second day, the body is black. Hence, dark cloud referred to its name. Let's once again revise important points for dark cloud cover. It's a 2-day reversal pattern that has bearish implication. The first day of this pattern is long white candlestick reflecting current trend of the market and confirm the uptrend to traders. Next day prices open above the today's high price, suggesting more bullishness, but second day prices trade lower than its open price and they trade mostly lower than the mid price of previous day, thus giving a bearish implication. Or a strong down day will make most of the traders to book their profit and exit from the long trade. Since the close price is below the price of second day, it is called the second bar is dark bar and it's called dark cloud cover. Now let's go ahead and see some examples. Following is a daily chart of NSE 100, and as of the last bar, prices have traded on 30 Jan 2015. As of the last bar, you can see a strong down day has taken place or a dark colored candle has come up. Taking a look at previous data, you will understand prices have trended quite well from 8,100 to 8,950 or almost to the levels of 9,000. The last bar prices capped up and traded lower. The previous bar was a strong up day. Maybe it was not that strong an up day, but still qualifies our setup. It was a strong positive close day. The next bar opened above its high and traded significantly below its previous close price and its own open price, It even took out previous day's low price here. Taking out of previous day low price itself will have forced many traders to close their long position, and most traders will have reversed their position. Let's go ahead and see what happens next. Next day came a somewhat doji candle or a day of indecision. Next day a sell day, a sell day, a sell day, and prices changed their direction eventually. So a dark cloud pattern is a bearish reversal pattern and is one a very strong psychological pattern which will clearly help us identify what is happening with traders. First, a strong close day telling us that the trend is continues to trade upside. Next day, prices gaps up, giving us more confirmation about the uptrend, but prices trade lower, significantly below the midpoint of previous bar, telling us that prices might have changed the direction, and then prices eventually change the direction. Now let's go ahead and add some bars and see if we can find one more dark cloud cover pattern. Gap down, a reversal pattern. Now if you take a look at this reversal pattern, it looks exact opposite of this pattern. Here strong close, gap up, and strong sell day. Here strong bearish close, gap down, and strong buy day. So this is exact opposite of dark cloud cover, and it is called piercing line pattern. We will learn about piercing line pattern, but first let us take one more example of dark cloud cover pattern. I'll add some bars. Prices have changed the direction. Gap up, hits 9,000, and we have one more dark cloud cover pattern in existence. Can see prices closed up, positive close, right? Next day gap up and close below midpoint of previous bar. In fact, it closed below the low of previous bar, suggesting giving a much more bearish implication. Now let's go ahead and add some bars and see what happens next. It looks like a spinning top or a doji candle. Day of indecision. Continue to sell lower, lower, lower. And you can see here one more. It's not really a dark cloud cover pattern as the overall trend is downside, so it cannot be considered as a dark cloud cover pattern. But you can see prices continue to fall lower or trend changed its direction after this pattern formed. Our next important reversal pattern is piercing line pattern. It is the exact opposite of dark cloud cover. The piercing line has bullish implication. Scenario is similar to dark cloud cover. A downtrend is in place. The first candlestick is a long dark candle which solidifies traders' confidence in downtrend. The next day, prices opens at new low and trades higher all day and close above the midpoint of the first candlestick body. This offers a significant change to downtrend mentality and many will reverse or exit their position. So this is exact opposite of dark cloud cover. Prices are trending lower, then you have a strong down day confirming the downtrend or in line with the downtrend. The next day, prices gap even lower, confirming the strong bearish momentum. Still, even after gapping lower, prices reverse and trade at least above the midpoint of previous candle bar, suggesting us that something is wrong with the downtrend. And eventually prices trade higher and change their direction. Now let's take an example. We have already seen this example, NSE 100 daily chart, and as of the last bar you can see prices were in downtrend. The previous day gapped down and traded lower, confirming the bearish momentum, and last day of this downtrend prices gapped below its previous day, adding more to the bearish momentum. But still prices closed well above their open price. The close was even above the midpoint of its previous negative bar day, suggesting us that something is wrong with this current downside momentum. Now let's go ahead and add some bars and see what happens next. Next day prices gap above its close price and trade higher. It even closes above its own open price, adding to the fact that prices have reversed their direction and prices tend to trade higher unless there we see a dark cloud cover again. So dark cloud cover and piercing line pattern are strong reversal patterns, but both of these reversal patterns are only useful when market is in either overbought or oversold condition, when market is ripe to change its direction. Hence, candlestick every pattern found in candlestick analysis needs to be used along with other technical indicators. Simple indicators which will help us understand the stage of market trend. For example, let's say this dark cloud cover and this piercing line pattern, they both are successful pattern. Now, is there a way how we could understand that market was ripe to change its direction? For these pattern to be successful, market was in its own way ready to change its direction. Is there a way how we could understand this? One of the ways how we could see if market is ripe to change its direction is to use some of overbought and oversold oscillators. There are many oscillators found, but conventional oscillators like stochastic, MACD, CCI, commodity channel index, and RSI could be used to understand the stage of current market trend. So I will add stochastic oscillator with its default setting, stochastic percentage %D. I'll add color will be black, and if you are aware, have used previously stochastic, you will know that 80% and 20% are the level where one must be aware that market might change their direction from these levels. So every time stochastic percentage %D reaches either 80 or 20, these levels are called overbought or oversold levels. So a stochastic percentage %D reading of above 80 is overbought. Stochastic percentage %D reading of below 20 is oversold. So I could use an oscillator to help refine these reversal patterns. We will talk more about this in later section, but I just gave an idea of how candlestick patterns could be used with simple momentum oscillators to find effective reversal patterns. So let's once again revise piercing line pattern. This is opposite of dark cloud cover. Scenario is similar to dark cloud cover, just that prices are trending lower, downtrend is in place. First candlestick is a long dark candle which solidifies traders' belief that downtrend continues. Next day prices gap lower below its low price, clearly telling us that market is more bearish than it was yesterday. But for the trading day, prices trade higher. In fact, they close above the midpoint of previous day's trading range, offering a significant change to the downtrend mentality, and thus most traders will bite the bait and reverse their position or exit the market. Our next reversal patterns are evening star and morning star. The evening star and its cousin morning star are two powerful reversal patterns. These are both 3-day reversal patterns that work exceptionally well. Evening star pattern. Evening star is a bearish reversal pattern. As its name suggests, the first day of this pattern is long white candlestick which enforces the current uptrend. On the open of the second day, prices gap up above the body of the first day. The trading is somewhat restricted and the close price is near open price while remaining above the body of first day. The third and last day of this pattern opens with a gap below the body of the star and closes lower with close price below the midpoint of the first day. The above example was a perfect scenario. Many references will be accepted as valid. So, an evening star pattern consists of a long white candlestick suggesting or confirming the current uptrend. Next day gaps up, but is the trading is somewhat restricted and close price is unchanged in relation to the open price, suggesting that market even though looks strong but is quite undecided. There is not much interest at current price levels. And the third day gaps down, continues to trade lower and closes below the midpoint range of first day, thus completing the pattern as a reversal pattern. Now, even though the rules laid down are somewhat objective rules, but many changes, modifications, or small divergences are accepted. For example, third day might not gap below, or the close of the third day might not quite be below the midpoint of the first day. We'll talk about morning star ahead in the later part, but for now we will focus mostly on evening star. So many small divergences to the rules are accepted. Let's go ahead and see some example for evening star. Following is NSE 100 daily chart, and the last bar is data for 18 December 2014, and you can see here we have a morning star which is exact opposite of evening star. Prices are in downtrend. Then we have a gap down day. We have the first day as a strong sell day, followed by a gap down day, and trading is, even though the trading range is big, but open to close is almost unchanged, suggesting that traders are not interested in selling it any further, any lower levels. Next day gaps up and close is above the mid range of first day bar. Let's add some bars and market changes its direction. You can see even the next day gaps above, significantly above, in fact. Our next chart is ONJC daily chart, and which has an evening star pattern. You can see market is in a steady uptrend. As of the second last bar, prices gapped up even though the close was above its open. But looking at the bar chart, you can see it looks like a spinning top or a somewhat partially undecided trading range. And the bar is above its previous bar price. The next day, prices gap below its close price and traded significantly lower, even though it was not, the close was not below midpoint of the first bar, but still you can see it is a long sell day. Such small changes can be made to the rules to identify these candle patterns. A significant sell day suggesting something is wrong with market. Let's go ahead and add some bars and sell price prices change their direction and continue to sell lower. Our next example is a morning star pattern. Prices are in downtrend. The first sell day is not that strong. Nonetheless, it is a sell day. Next day gaps down, trade significantly lower, but closes unchanged, suggesting extreme indecision among traders. Next day, prices does not gap above its previous day's close price, but still it closes strongly above its own price and above first day's midpoint range. Now let's go ahead and see what happens next. Prices continue to trade higher, and eventually this became a bottom. Our next example is an evening star pattern for Patel Engineering Industries daily chart. This example is for April 23, 2014. As of the last bar, prices have gapped up and closed undecided. Looks like an uptrend with strong up day. Let's add some bar. Prices gap below its previous day's close, trade lower even though it is not below the mid-range of first bar, but still the pattern carries all the essence of an evening star pattern. Let's add some bars and prices continue to trade lower. So let's once again revise the essentials or rules of evening star and morning star. Remember, morning star is exact opposite of evening star. So the rules applied for evening star, they need to be exactly mirrored to apply them for morning star. So rules for evening stars are: it is a bearish reversal pattern. First day of this pattern is long white candlestick, confirming current uptrend. Next day prices gap up, but trading is limited and close is somewhat unchanged. Third day prices gap down, trades lower and closes below the mid-range of first day. Similarly, an exact opposite is morning star. For this, prices are in a downtrend. First day prices, there is a strong downside close, confirming the downtrend or in line with the downtrend. Next day prices gap lower, confirming the downtrend, but trading is limited and close is somewhat unchanged in relation to its own open. Next day prices gap up and close and trades significantly above and closes above the mid-range of first day candle bar. So evening star and morning star are both very important reversal patterns. Our next pattern are continuation patterns. A candle pattern that helps identify the fact that current trend is going to continue. will help stay in trend for longer time. Identifying such patterns helps answer questions like whether or not one should remain in a trade. Japanese literature refers to 16 continuation candle patterns. Among them, one continuation pattern and its opposite sibling are particularly good at trend continuation identification. Rising and falling 3 method. Rising 3 method is a bullish continuation pattern and can only occur in an uptrend. The first day of rising 3 method is a long white day which fully supports the uptrending market. However, over the course of next 3 trading periods, small body days occur which as a group trend downward. They all remain in range of first day's long white body, and at least 2 of these 3 small bodied days have black bodies. This period of time when market appears to have gone nowhere is considered by Japanese as rest period. On the fifth day of this pattern, another white day develops which closes at a new high. Prices have finally broken out of the short trading range and the uptrend will continue. Now let's talk about if we can make some changes to this pattern. For example, a 5-day pattern such as the rising 3 method requires a lot of detail in its definition. Flexibility can be applied with some success, and this only comes with experience. For example, the 3 small reaction days could remain within the first day's high-low range instead of body range. The small reaction days do not always have to be predominantly black. The concept of rest day could be expanded to include more than 3 reaction days. Exact opposite is true for falling 3 method. Now we should not ignore the rising and falling 3 method patterns as it can give a feeling of comfort when we would be worrying about protecting our profits. Let's go ahead and see some examples. Following is a daily chart of Patel Engineering Industries, and you can see prices are trending higher, suggesting us of an uptrend. As of the last bar, it looks like its high and low price are contained in its previous bar high and low price. So let's go ahead and add some bars. The second day high and low price are also contained in first day and third day. All three are negative bars. Third day price is also contained within the first day price, although third day traded a bit lower below its first day strong day close day, but still it does look like rising 3 pattern. So let's go ahead and revise rising and falling 3 method. Rising 3 method is a bullish continuation pattern. It can only occur in an uptrend. The first day of rising 3 method is long white day which fully supports the uptrending market. However, over the course of next 3 trading periods, small body days occur which as a group trend downward. They all remain in the range of first day's long white body, and at least 2 of these 3 small bodied days have black bodies. This period of trading of time when market appears to have gone nowhere is considered by Japanese as rest period. On the 5th day of this pattern, another white day develops which closes at a new high. Prices have finally broken out of the short trading range and the uptrend will continue. Exact opposite applies to a falling 3 method, which is a bearish continuation pattern. Market will first day will be a strong sell day or a strong black body day, followed by 3 small body days which trade within the range of first big black body day, and the fifth day pattern is completed when the fifth day trades to a new low and closes below the first day low. Now that we have learned some of the most important reversal and continuation candlestick patterns, let's go ahead and see if we can code these patterns into computers. So using computers for pattern identification. A computer with a software designed to identify candle pattern is a great way to remove emotion, especially during trade. A computer needs objectively defined rules to filter given rules through piles of data. It will help us remove any vision-based bias. Filtered candlestick patterns. An effective filtering technique developed by Craig Morris in 91 called candle pattern filtering provides a simple method to improve the overall reliability of candle patterns. Determination of overbought and oversold markets using traditional technical analysis will enhance a candle pattern predictive ability. Concurrently, this technique helps eliminate bad or premature candle patterns. For example, stochastic percentage D oscillator could be used to identify overbought or oversold market conditions and then identify candlestick reversal patterns. We have already seen this in previous part when I showed you how reversal patterns could be used in along with overbought and oversold market condition to eliminate premature reversal patterns and help identify patterns that are occurring at a ripe time. What do we know about stochastic percentage D? When percentage D enters the area of above 80 or below 20 condition, below 20 area, a condition for reversal signal exists. The area in between 20 and 80 will be considered as a zone for premature signals. So the concept of filtered candle pattern uses this premature signal area to filter out reversal signals in candle patterns and consider only reversal patterns that occur either above 80 or below the area of 20. Any oscillator can be used to filter candle patterns. It can be CCI, William percentage hour, or RSI. So any oscillator which has an overbought or an oversold zone can be used to identify reversal patterns. The important point to keep in mind is reversal patterns that occur when market is ripe for a reversal are best patterns to be traded. Any other reversal pattern which occur in a premature zone should be filtered out. Hence, reversal pattern can be filtered with the help of one more technical indicator, which is any kind of oscillator with overbought and oversold zone. Using reversal patterns along with oscillators will definitely help us improve our trading efficiency and success ratio. Conclusion. Japanese candlesticks charting and candle pattern analysis are essential tools for market timing decisions. One should use Japanese candle patterns in the same manner as any other technical tool or technique, that is, to study the psychology of market participant. Japanese candle patterns used in conjunction with other technical indicators in the filtering concept will almost always offer a trading signal prior to the use of other price-based trading signals. So that concludes our tutorial on Japanese candlesticks.